Hi everyone, my name is Vivek Rao, and I'm the CTO of SiteSearcher AI.
Mike Rousas, CEO of SiteSearcher.
And we're here today to just talk about a few low risk ways to invest in commercial real estate, especially if you're just starting out. Michael has decades worth of experience in this area. I'm interested in getting into it myself, so we decided to set these conversations up as a way to for me to ask questions and for Michael to basically teach myself and you guys just how to get into this. So Michael, starting off. For somebody who's just getting into commercial real estate and wants to work on their first deal, what are some low risk ways to start off?
Yeah, one idea is to look for sites that have vacant buildings on them and think about ways to re-tenant them.
And so if I go looking for a vacant building, and then I find it and then I find it and there's no tenants on there, what's what's the next step after that? What's the next step once I've found that kind of site or that kind of location?
Yeah, once you've found the building, I think the next logical question is what type of user could step into that space with as little as uh, capital improvements as would be possible. So, one potential example is a bank where the former user has vacated the space and then reaching out to maybe smaller community banks or credit unions or national banks that just have a market gap in the location where that vacant bank exists and reach out to those potential users to see if they're interested in leasing the space.
Okay, so then let's say I've reached out to a few banks, and or rather I've gone online either to Google Maps or to SiteSearcher, and I've figured out a way to find sites that are basically, you know, more than a mile away from an existing branch location for any given bank. Uh, how would I go about structuring a deal for that kind? And let's say that I've got that location on the contract, it's all settled, I've got the loan for it. Now I'm at the point where I want to lease it out. How would I structure that kind of deal to minimize the amount of cash that I would need to put in?
Yeah, and I guess the first step is finding the right tenant. And so, I would do research to see, number one, who has a gap in that market gap in that specific location, which players are interested in expanding into that market, reach out to their development managers or real estate directors and try to get a sense of whether that general area, market, location is a place where they would be interested in leasing space. And so once the property is under contract, I would begin negotiating with those specific users that have expressed interest in the space. And the idea would be that you would sign a lease with that tenant before you even close on the property. And so by the time you would need to close, you'd have a guaranteed tenant in place. And that would also make obtaining the financing a lot easier because the lender would have a guaranteed stream of cash flows to cover the debt service. And so, in a scenario like that, where you have a tenant in place, a lease signed, a guarantee in place, and ideally significant cash flow relative to the price you paid for the property, the amount of cash equity that you'd need to put into the deal would likely be minimal.
And all right. So I found the directors and talked to them, and I put a deal in place with them. They've signed it. We're ready to go. They're ready to move into the location. Um, how long before I start making money on this deal, and how long before the money starts flowing in and they start paying the lease? Um, how does that work, and how can I plan for the interim where they're getting set up and everything?
Yeah, I mean, general rule is tenants don't want to start paying rent until they're ready and open for business. So the lease terms will typically say that there's, at least a minimum period of months where the tenant has the opportunity to improve the space and retrofit the space for their intended purpose. Now, in the event of second generation space where, for example, a bank would be stepping into former bank space, it could be the case where the bank building had actually been updated just a couple of years ago. And so the new bank's really able to step right in there and just do very, very minor cosmetic improvements. Or could be a case where the bank had been in that state for 20 years, was never improved, needs a roof, structural improvements, cosmetic improvements that would take a period of months. So in that case, you'd likely have a little bit larger gap between the period that you acquired the property and the period that you would start receiving the cash flow in terms of the rent payments from the tenant. Now, in that scenario where there would be, a fairly material gap between closing and the start of rent payments, what you could do is negotiate with your lender so that during that gap period, either payments on the loan are deferred, or it's just an interest only period where your out-of-pocket costs would be minimal.
That's cool. And then after that, let's say I've owned this deal for or been in it for 5 or 10 years. Um, what would be what's going to be my exit strategy? Like, am I gonna sell the property later on down the line? Should I hold on to it? What would be the driving points to figure out, how I'm going to finally uh, exit out of this deal?
Yeah, it depends really on your objectives as a buyer, right? I mean, some buyers, they're just really interested in the cash flow. Some buyers are interested in selling a property as soon as it's leased and then taking those proceeds and, either doing 1031 exchange and putting it into your next deal, or, doing whatever you want with them. And so I guess in terms of considerations, right? Things to think about when you're deciding between your exit strategies. Typically, and especially in this scenario where the tenant is a triple net credit A grade tenant, once you've leased the property, let's just say you have a 20-year base term on the lease with a couple 5-year renewal options. In that scenario, as soon as the lease is in place, if you were to sell the property, the buyer knows that they're going to have a full base term of rent payments. And so the way to sort of maximize the value of those cash flows is to sell as soon as the is in place. Because on the other end of that continuum, if the lease just has 3 years left on the term, then a buyer is going to expect a higher cap rate and a lower sale price, because at that point they're taking on the risk that the tenant would not exercise a renewal option and would vacate the space, which would mean that they could be left holding a vacant building, which is almost like a liability in the sense that you have to pay the taxes, maintenance, and insurance on it, even though it's no longer an income producing asset. And then the other issue is as the lease term reaches expiration, it's typically more difficult to obtain financing for the property as the buyer because lenders typically want the lease term to extend beyond excuse me, the lenders want the mortgage term to extend beyond the term of the lease. And so um, if you're buying a property that only has 3 years left, the lender's typically only wanting to give you, 2 to 3 year mortgage term. First of all, that's hard to get those types of deal terms, but it's also just going to be difficult to find a lender to provide that short-term debt. And so that's another reason why if you're trying to sell the property towards the end of the lease term, it can be harder to do.
See, that's very interesting because I would have thought that, if I've gotten into the deal, then, I'm going to be in it and I'm going to pay off my loan first. And once I've paid off my loan or I'm getting close to paying off my loan, then it would be an ideal time for me to sell because by then I have just all this history built up of just a whole rent roll for that many years. And I've got a tenant who's, pretty solid and they never missed a payment and so on. But it sounds like those are not the metrics to decide when to exit because there's really two options here. One is you exit in the beginning of you found a tenant and they've been there for a year or so and everything's fine, and they have many more years on their lease term left, or you hold on to the property for a lengthy period of time because maybe you're in an area that's developing fast, and so the value of the property itself is going to go through the roof. Um, and yeah, that was just super interesting to learn.
Yeah, and there are some cases where it may be more advantageous to you as a interested seller of that property with a lease in place to actually not sell it year one or as soon as the lease is in place in situations where you've leased it to a non-credit tenant, a non-national tenant, more of a mom and pop. So, for example, if you're leasing it to a restaurant and this is their first location, a potential buyer would likely think, wait a second here. If the tenant is someone that has no operating history, it is not really a creditworthy tenant. I'm not interested in buying this property and taking over this lease unless I have more confidence that the restaurant is going to be thriving this location. So in cases like that, it may be better to sell the property in year 2, 3, or 4 once there's an operating history and a potential buyer has more confidence that the tenant can continue to perform. And then also in those situations where it's more of a mom and pop tenant, maybe as the landlord, you have required the tenant to report sales so that you have verification of their performance. And that is something else that you'd be able to present to a potential buyer to verify that the business is performing well, and that they'll have no issue with making those rent payments.
Yeah, that's super interesting. Um, but yeah, but all this sounds great, and it sounds like it's pretty low risk way to get into something like this. Um, but what are the potential risks with this kind of deal? What could go wrong?
Yeah, well, I mean, it's always possible that within a certain, if you're holding the property for the long term, it's possible that at some point during the term of the lease that the property goes dark, meaning the tenant closes their doors. So, you know, the main way to protect yourself in that scenario, at least to be sure you're continuing to collect rent, is doing business with a creditworthy tenant and getting a guarantee from a person or an entity that's well capitalized and you have a high probability of continuing to collect those rent payments even when the doors close. Now, in that scenario, even though you will be protected in the sense that you should continue to receive rent payments, even though the business has closed down, there's still risk in the sense that if you wanted to sell the property at some point, then any potential buyer is going to see that the existing tenant has shut its doors. And so that serves as a black eye on your site. And then at the same time, lenders are going to be more averse to providing financing on sites where the tenant has closed their doors because um, they see that as risk in terms of the site and then risk in terms of potentially a broader issue with the tenant that could lead them to eventually not making their rent payments, even though, there could potentially be a guarantee in place. So even when you do sign that, single tenant, triple net lease and get that guarantee and have a credit tenant in place, never know what the future holds, never know what the broad macroeconomic environment can hold because there's many cases where landlords have signed leases with creditworthy tenants, but you know, years down the road, economic environment changes, business models change, competitors come in, and so that tenant, which was a grade creditworthy tenant at the time of the lease signing, may not continue to be in that same position throughout the remainder of the lease term.
Well, Mike, it's been interesting talking to you. I hope to make more of these videos with you where we dive deeper and deeper into commercial real estate as we build out SiteSearcher. For anyone watching the video who's interested in what we do, I've included a link to our website, and you can sign up, and we'll get in touch with you, possibly to show you a demo of what we've built. Thank you very much and have a good rest of your week.
Thank you.
Thank you. Bye.